Howdy, Jacob here. Today we're looking at Tower Semiconductor, and you'd never guess it. The semiconductor and equipment industry, 3.6 billion market cap, slightly less enterprise value. Growth has not been very substantial, but averaging out to mid-single digit from 828 million in 2014 to 1.4 billion in 2023. Gross margin is up quite a bit, and operating margin is actually higher than what their gross margin was 10 years ago. So very impressive from a margin standpoint, fairly impressive from a growth standpoint. Down quite a bit though. It is a cyclical business. We do know that the semiconductor business has very high growth rates and then can get dampened very quickly due to both supply and demand. And return on invested capital recently very good. But again, if you take the average, it is probably double digits still. But just keep in mind that if you do invest in this company, it will be a volatile from a return standpoint for sure. Their balance sheet shows about 440 million cash-like products with 173 million long-term debt, 59 million short-term debt. So very safe from a balance sheet perspective. They have enough cash to just write off the debt. Huge investments. Great investment. This is a company. There's very few in this screener that we've done where a company actually reinvests a hefty amount of their cash flow into the business. And what that does is it definitely spurs growth as long as it's reinvested well, obviously. We can see that historically they have probably averaged mid-tens, maybe in the mid-teens type of growth rate. And they are absolutely reinvesting back in themselves, which you can see through capital expenditures as well as this investment line. Their capital expenditures were 50 million in 2014 and are now 432 million in 2023. So capital expenditure is one of those things where it's like there's really two parts of it. There's your innate growth of just keeping the business as is, but there's also reinvestment. And so I think the most obvious one that I could think of is an Intel, where they're building plants in, I think, Phoenix and the Columbus, Ohio, or Cleveland, Ohio, somewhere in Ohio and somewhere in Arizona. They're making a huge power plant, and that's going to show up in your property, plant, equipment. So that's not to sustain business. That's to hopefully down the line add some growth. And so your capital expenditures line or property, plant, equipment of the cash flow statement can show you companies that are really reinvesting back in themselves. A company like Amazon has just increased it every year, miles and gallons. Basically, every money that they get, they just pay out. And so their form of reinvestment is phenomenal, one of the best in the business. Them and Tencent have historically been the two best reinvestors that I know of, at least. And this company is doing a fantastic job of reinvesting back into themselves, which few actually do. Few have great returns on invested capital, but it looks inflated due to their share repurchases, their share repurchases inflate that denominator, or deflate that denominator, which can really inflate your return on invested capital. And so here, their use of cash is almost entirely reinvestments, slight debt pay down. I mean, that's fine if they have a little bit of money to pay that debt down, but their debt is not substantial. Like we've said, their cash on hand and cash like products are more than their debt. So this company is really reinvesting a lot back in themselves. So, have they done a fantastic job is a different story. I mean, we do see 64% year-over-year growth, but also -6. We are probably averaging out, let's see, equals 1.423 over 0.828. The power of 1 over 9 minus 1. So they've grown about 6% CAGR over the last 9 years here. And I feel pretty comfortable with that. Since they are reinvesting back in themselves, this figure right here does show that reinvestment, and also I'll incorporate it into the margins here. So 14, 11, and they have been growing a little bit, so maybe let's do 16, 15. Share change, increasing likely due to stock-based compensation, so let's increase that with I'll just increase it 1%. So pretty much in line with what they've been doing historically. Terminal PE, through their reinvestment, I will say that although their growth might not be that substantially above the market at the end of 7 years, I think their ability to reinvest back into themselves through hopefully making the company more efficient. Again, this is banking on the fact that they're reinvesting well into the business. I think that these assumptions make a lot of sense to me. But again, if you look at the valuation, it still looks a tad expensive here, and I will be waiting for it to drop more. But business itself, I love that they're reinvesting. I would like to do more research to see if they're reinvesting well, because if the company's just taking your money, not getting high rates of return on it, that's just as bad as them buying back their shares that are expensive. So, I hope you enjoy the video and have a great rest of your day. Thank you.